Welcome back to Invest Global. Today we're going to be discussing inflation, the US dollar index, crude oil, and the overall macroeconomic situation we currently stand in. Now, the most important thing I want you to understand is this chart right here. So many people look over the Dixie, which I think the Dixie, crude, and the 10-year yield are literally the three indicators. If that's all you look at, you can have your finger on the pulse of the macroeconomy. Just like every single day on this channel, we talk about daily DeFi. That's a series that we do every single day. And to keep my finger on the pulse of that market, I just look at DeFi Pulse, which is basically the total value locked in decentralized finance. Now, with the US dollar as the global reserve currency, we're on a much, much larger scale. So this is much, much more important for kind of changing this. You can think about it like decentralized finance is like a jet ski if the US dollar and kind of the bond market and the stock market is like a giant aircraft carrier. For them to turn, for them to actually adapt, it's going to take a lot more time, and it can sink very, very fast. Versus if you're on a jet ski, you're much more mobile. Now, the jet ski isn't as strong; it doesn't have as much, history, I guess you could say. But when you're looking at the U.S. dollar index, obviously has a lot of history. So this is just on the 4-hour chart. We can see back here at March of 2020, really when everything started to hit that crash. That's when we saw this steady decline in the dollar index. So you can see a lot of people don't realize this. I'll wrap this up in how it affects inflation is because look at the U.S. dollar's strength weakening to really lows here. I mean, if we go all the way out and just zoom out the total U.S. dollar index, obviously these are all-time lows. Our all-time lows are down here, but this is, back in '08, back in kind of the crisis there, those were really our all-time lows around that $71 mark. But what we're seeing here is this overall, the macro trend is to the downside, okay? So in my opinion, we are seeing inflation, but it is not upfront inflation, okay? So it's being seen in the commodities market. It's being seen in really all capital markets where real estate is incredibly overvalued. Look at the real estate market. Ask anyone in your local community. The houses on the market, I mean, they're going for above offers. People are literally coming in the U.S. I've been in the U.S. for about 2 weeks now. I was only planning on staying here for a week, but it ended up being a little bit longer. I do fly out to Tbilisi, Georgia this weekend. But while I've been here, I've been very interested in what's been going on. I mean, everything is ridiculously over leveraged in the United States. And I think this is a massive problem. And we see it in things like the Dixie. And, when crude oil goes higher, for example, over here, crude oil's hitting these. Obviously this is the all chart, but let's look at the yearly chart. I mean, look at this. It's at these yearly highs. And typically, as kind of a general rule, when we see a higher WTI crude price, this is really stock market positive. And same with, by the way, if you're looking at, okay, what is the dollar index? So, what does this really mean? Okay, so as a general rule, the weaker the dollar index, the stronger the stock market. So you can use this, okay, as it's getting weaker, the stock market's getting stronger. The stock market is, the NASDAQ. Look at this. The NASDAQ still on these all-time highs. Let's just go to the all chart. I mean, look at this. It continues to go up while you see these actual problems in the economy. So this is the disconnect. This is kind of what I'm calling it, is the disconnect between capital markets and the real economy. The real economy is unemployment numbers. The real economy is, people, the crisis of jobs in the United States. And this is just looking at it from the United States perspective. Then when you go global, that would be for a different video, obviously. But this is mainly focusing on the U.S. because not because the U.S. is the best country at all. That's why I specifically like to invest in emerging markets and not invest as much in the U.S. The U.S., the reason you have to take it into account in the macro is because it's the global reserve currency. So U.S. dollar is very, very important to understand, and the U.S. dollar index is vital, to actually tell what's been going on. And with all these things to keep in mind, you see these problems here. Well, guess what? The Fed keeps denying inflation. Really what this is doing is it's prolonging the burst. I really think we are going to see a recession at some point in time. They're prolonging this recession because if basically the longer they can say that inflation is not a problem, don't worry about it, look here, don't look here, this kind of narrative, the longer the Federal Reserve can do this, the longer you can kind of prop the stock market up. And you have to understand a lot of the people involved in this, have a lot of money tied up in the whole situation. So again, this is kind of for a longer episode. I could dig into that. I highly recommend you read the book, The Creature of Jekyll Island, which talks about the creation of the Federal Reserve. Also, go check out my video on basically where I break down, the Federal Reserve versus the Treasury, and then how broad money affects base money, and that's really where inflation comes in, yield curve control, with kind of these two approaches that I talk about, with the full spectrum approach versus the front end pin approach. And it's just a great video over here. You can check that out. I'll have it linked down below in the description. So the point I wanted to make here is, the Fed keeps denying this. So recently they came out and said, inflation, it's over. Now everybody can get back into stocks. Everything's hunky dory. Well, what's going on in the real economy? We're seeing massive problems in the real economy. Whereas, like I said, again, the NASDAQ, all-time highs, everything's hunky-dory. No. That's not what's happening really. So what we've been doing is just kind of prolonging what's going on. And I'll kind of read you some interesting articles here. Everything we talked about will be linked down below in the description. But I did want to start off with this. So Fed Evans says easy monetary policy has his full support. So the recent rise in U.S. inflation is unlikely to lead to a kind of undesirably high inflation that some notable economists have warned about. Federal Reserve Bank of Chicago President Charles Evans said on Tuesday, reiterating his support for the Federal Reserve's super easy policy. I have not seen anything yet to persuade me to change a full support of accommodative stance of monetary policy or our forward guidance about the path for policy, Evans said in his remarks prepared for the delivery to Bank of Japan conference. Critics, including former Treasury Secretary Larry Schumer, said the Federal Reserve's promise to keep rates at the current near zero level until the economy reaches full employment and inflation has reached 2% and is on track to exceed the level moderately for some time is a recipe for overheating the economy. So this is something that's very, very important to take into mind, guys, is they're for this monetary stimulus. They're for kind of this increasing in money supply. And you, again, check out this video to understand how this really works, because it's not just black and white. It's not like, they pass more stimulus bills and we see inflation right away. No, what we see is how they're controlling inflation, which is through yield curve control. And then that's, again, check out this video for that. If you want an updated video, let me know in the comments. I can do that as well. Specifically on inflation, specifically on the Treasury, specifically on the Fed. Any type of video where I go deep into that, just let me know in the comments and I will be happy to do it, because these are all topics I'm very interested in. So let's return back here. So it's especially true to say in the light of trillions of dollars of government spending Congress has passed to deal with coronavirus pandemic and cushion its impacts, but could, in these critics' view, stoke the kind of inflation not seen in decades. But that outlook, Evans said in his remarks, depends on the accelerationist view of inflation, in which the experience of higher prices drives even higher inflation expectations among households and businesses, who then incorporate those expectations into their buying price setting decisions in what becomes a self-fulfilling spiral upwards. Okay, basically to synthesize that, guys, is you have to understand when you see inflation, typically nobody's going to come out to you and go, hey, look, your inflation rate is, you're seeing inflation that's affecting your socioeconomic class at 10%. Well, most people now just think it's 2%. Like, okay, you look up what is the Federal Reserve told us. So anyone who's like a complete noob to this space, like completely new, might just look up, okay, what is the inflation rate? So let's just look that up, exactly what Google would tell us. What is the inflation rate? Most people it'll probably say around like 2%. Investopedia. This is not, by the way, where I go to research things. This is like as I said, kind of the new person entering into markets. This is probably what they would look at. It'll probably say it on here around 2%. But what you have to understand is inflation affects everyone differently. It affects your socioeconomic class differently. So here we go. Let's go rate of inflation. Yep. Okay. So 2021, 2.26. Yep. So 2020. Okay. So here's what's more important is you have to look, okay, what has previous inflation been? And then look at other economies, look at other countries. And then you have to understand, okay, the US is a global reserve currency. So you have to understand that most people, if your money is sitting in a bank account in the United States of America, you are losing money every single year. And you're going against what Albert Einstein says. What Albert Einstein says is, what is the eighth wonder of the world? Well, it's compound interest. He who understands it earns it, aka investing. He who doesn't pays it, aka not having your money in the right place, having it in US dollars. You are compounding in the wrong direction. It's compounding against you. Inflation is hitting you if you're just literally holding your money in fiat currency. So what you have to understand here is these are rates for every socioeconomic class. But you have to understand the people that the top 0.01% hold a majority of their wealth and assets. Even the top 1% hold the majority of their wealth and assets. And you have to remember the wealth inequality is really a Pareto. It's a Pareto distribution, right? So a Pareto distribution is basically saying that 20% of a group typically owns 80% of the total wealth. So that's true in the global economic situation, and it's even worse than that. It's really like 1% of America owns the majority of the wealth, or sorry, 1% of the world owns the majority of the wealth. And those people hold their money in assets. So as inflation increases, they get positive upside. They don't hold their wealth in dollars, in something that doesn't have a fixed cap. That's why something like Bitcoin is so important. And that's why inflation is vital. If your money is sitting in bank account, if you are paycheck to paycheck, you need to you're kind of running by the wheel right now. You're about to get destroyed. Like seriously, if you are paycheck to paycheck and you're listening to this right now, you need to figure out a way to get into some sort of inflation hedge asset, whether it's gold, whether it's silver, bullion preferably, whether you're looking at gold mining shares, silver mining stocks, all these different commodity stocks that I talk about. You can watch my videos on that. Or if you're looking to get into the blockchain space, I think it's a great place to get started, especially if you're unbanked. If you're an emerging market country and you don't have a bank account, or you don't trust your currency in your country, especially against hyperinflation, well, you should get into inflation hedge assets. You should get into some great quality crypto projects. I think if you look in the top 5 projects of the overall crypto market, consider looking at some of those. Consider looking at key levels to enter in on the chart. We have experienced a bit of a pullback, so it could be an opportunity, not financial advice. Just use this as educational purposes. Form your own opinion, form a thesis, identify a narrative in the market, test that thesis against an antithesis. So seek out disconfirming beliefs, so people that completely disagree with you, and then you'll find the synthesis. The synthesis is the new thesis, and it should be an ongoing cycle. So you should always continue to test your methodology in the market. So that's something that's vital for you to do. Again, I think the thing with the lowest barrier to entry is crypto. So that's why I talk about it a lot on this channel, especially during this bull run. But the point here is, guys, is inflation, to wrap this all up, does not affect everyone the same. So these numbers, if you're paycheck to paycheck, inflation might be literally 10% because you don't have any money in assets. And guess what? In America, that's the bottom 50%. So half of Americans have no investable assets. It's absolutely insane. And especially I'm from here in Iowa. It's the state with the largest amount of truckers, and a lot of truckers are construction workers. They're very paycheck to paycheck, and they don't understand what's coming with automation, which is a whole nother conversation. But to kind of wrap this together is you have to take that into account with inflation. You have to understand that they're not going to come out and tell you there's inflation. You'll see inflation after it's already too late. That's the problem of just going, oh, I'm not interested in this. That's why I'm so interested in capital markets, is because this affects everyone. Everyone is deriving their value on earth, the problems that they solve, their job, whether you're an entrepreneur, whether you're helping someone with a service business, a product-based business, whatever it is, whether you're flipping burgers at McDonald's, you're providing some sort of value. You're fixing some sort of problem. And the thing everyone's deriving that value in right now, the global reserve currency, is the US dollar. And the US dollar is being inflated away, which people don't understand. So it's very, very important to keep your eye on so I would say risk off assets. When I say risk off assets, those are things that I talk about, like inflation hedge assets. So personally, I'm not bullish in kind of developed countries real estates right now. There are some emerging markets that have compelling real estate opportunities. One of the main things is always diversifying. So having multiple bank accounts around the world, having ideally multiple crypto wallets, some gold vaults, some kind of precious metal vaults is powerful. Maybe even some art. If your net worth is high enough, you can gain exposure to the art market by using something like Masterworks. But the idea is to get in risk off assets. I would say risk on assets is what the Fed is kind of pushing money to, because they know it'll affect the bond market if they say, we are going to see these high inflation levels. But as long as they can say, oh, don't worry about it, look here, don't look here, they will be able to kind of prolong this collapse. And I think it's very, very important to understand what they're doing here and how it's a little bit doing it by design. Now, again, I'm not trying to spread my opinion. I'm literally just looking at this objectively, telling you basically my thesis around this. Okay. So I'm not saying this is the end all be all. I'm always open-minded. I'm always open to continually iterate and improve my thesis. And that's using that cycle that I talked about. That's forming your thesis. So instead of an opinion, form a legitimate thesis, like a scientific approach. Okay. And then seek out people that completely disagree with your thesis. So Seek out disconfirming evidence. That's the antithesis. And then the synthesis is what you find after testing those things together. After you test the thesis against the antithesis, you find the synthesis, and guess what? You don't stop there. It's an ongoing cycle. So that synthesis becomes the new thesis, and it keeps going from there. Always be testing your approach, your thoughts against people that disagree with you. Don't get trapped in these kind of confirmation bias bubbles, these kind of echo chambers that so many people do. Let me grab a drink of water here, and then I'll return to kind of some of these stories here. A little rant over. So let's see here. So basically the Federal Reserve saying the inflation scare is over. The Fed one is just getting started. So investors have digested the idea that inflation is currently running above previous expectations. Now, the focus shifts to the Federal Reserve and how quickly it will respond to the rise in prices. There have been plenty of reasons of concerns. Measures of inflation and the prices consumers pay have consistently exceeded forecasts in the past several weeks. A year ago, prices were knocked over by the pandemic. So they are rising rapidly as life in the United States returns to normal. Trillions of dollars in government aid is creating demand, while problems in the supply chain are raising costs of companies, forcing them to raise prices. The Standard & Poor's 500 is essentially flat since mid-April, a stretch that included a 4% pullback. The prices in the bond market indicate investors expect inflation over the next 5 years to come at an annual rate. That is ridiculous. This is what I'm talking about in the bond market, guys. This is insane. So I think people get so confused by this. Again, let me just hammer this in. The point that I hope you understand this. Let me know in the comments if you understand what I'm saying. Inflation does not affect every socioeconomic class the same. That is so freaking important. So many people don't understand it. And it's going to hurt a lot of people. It hurt a lot of people in the 2008 crash. And that's why I'm speaking about it now. It's because I know there is a crash coming. Who knows when? It literally could be multiple years down the road. It could be in 22, could be in 23, could be in 2030. Can literally be propped up as long as people still hold belief that the Federal Reserve and the Treasury are doing the right thing, which they are not. They are not doing the right thing. They're borrowing from Peter to pay Paul, if you understand what that means. They're essentially they're doing the opposite of Stoicism. They're being Epicurean, essentially. They're only focusing on fixing today's problems and essentially stabbing ourselves in the back for a years from now problems, just basically delaying these problems. So they're just going for instant gratification instead of long-term thinking. And this is a giant problem. A nation is born stoic and it dies Epicurean. So very, very important to understand here, guys. Again, that's how they're pricing this in the market. Is the expected rate is 2.62%, up far less than 2% at the start of the year. Still, the expected rate is down more than 2.7% on May 10th. That inflation shock fear eased over the past week, wrote Dennis Debushkuri, head of the portfolio strategy research at Evercore. Now investors are watching the Fed to see how quickly it will respond to the inflation. The Fed's first move would likely be to reduce the amounts in bonds it has been buying as a part of its efforts to keep interest rates low and the economy running well during the pandemic. Less money moving into the market would reduce bond prices and raise their yields, increasing the cost of borrowing for home buyers and corporations alike. Higher yields also erode the current value of future cash flows, bringing stock valuations lower. So this is all very, very important to take into account. Let's wrap it up here. And then we'll move on to just kind of my last point here as far as inflation goes, and I'll kind of put a bow on this whole video. It's probably going to go longer than I initially expected. So the minutes from the Federal Reserve's April 28th to 29th policy meeting published last week even raised the possibility that members may begin discussing scaling back or tapering the asset purchasing program at coming meetings. In investors' eyes, the tapering signal timeline was pulled forward to July instead of August, Debushkuri says. And while tapering would be the first move, the second might be to raise the benchmark lending rate, an action that could come sooner than expected. The futures market for the federal funds rate is now reflecting a rate just under 0.25%, up from 0.2% a few weeks ago. According to Evercore data, the Federal Reserve's current target range for the rate is between 0 and 0.25%. The point is that investors are now expecting interest rates across the board to rise sooner rather than later. Don't be surprised to see significant stock market volatility as the Federal Reserve story unfolds. So this article, I like it because it actually is somewhat objective. Now, in my opinion, any of these things that you look at, whether it's CNBC, whether it's Fox, whether it's even MarketWatch, whether it's whatever. Statistica is a little bit different. They're typically biased. When it's a centralized organization, they do have a bias. They have advertisers taken into account. They have their kind of demographic and kind of their narrative to take into account. You have to remember, these are for-profit businesses. Now, the more objective news sources we get, the better. And I'm trying to make this channel as objective as possible. I'm not, again, the main thing here, guys, is don't go off anyone's opinion. You need to test your own. You need to test all these. Basically, you should be inputting data. You should be learning things about the market, and then forming your own opinion. That's kind of the thesis, antithesis, synthesis I talk about. But the main thing is to not just take these things as for facts. If somebody's on whatever social media site, this is the reason I personally do not use social media at all. I use Twitter literally for business, but besides that, I don't use social media because the algorithm is made for an echo chamber. So it's literally to confirm your bias. It's basically giving you as much confirmation bias as possible, feeding you things that you click on, and it's just very, very negative for your kind of objective view on things. And being objective in capital markets is one of the most important things you need to do. So that's basically it for this episode. Like I said, these are kind of those articles I showed over here. The Federal Reserve over here from Reuters is saying that the Fed thinks it can have it all: a strong economy, job growth, and stable inflation. This is just not possible. Federal Reserve Evans says recent strong inflation readings are not the start of a persistent move higher. So we are likely to see a big move up in April. Personal consumption expenditure index when it released on Friday. Okay, so that's very important to take into account. Like I said, go check out this video again. I'll have it linked down below in the description. Keep this in mind, guys, when you go to the all chart. Always zoom out to the all chart. Seeing new all-time highs yet again in the NASDAQ, or at least we're close to those all-time highs. While this inflation is not, you should be looking at this completely differently. Most people just see this chart and they see it for face value, but understand that each of these is throwing literally a blanket on the total economy. So every single person in the economy, they're saying, oh, your inflation rate's 2.25%. This is the worst way to measure inflation. You should be measuring inflation by your socioeconomic class, basically. So let's say you're top 0.01%. Measure inflation differently. They basically have little to no inflation because they hold their money in assets. Inflation affects them way differently. Whereas inflation, if you're paycheck to paycheck and you have no money in assets, it's going to affect you a ridiculous amount. So keep this in mind, guys. As the dollar devalues, the Dixie, literally look at the Dixie. It has gone down. I purposely pointed this out. Since those marches, down there. And I think this is going to be a significant breakdown. We might see a recession where we literally fall down here. I think we could hear some talks about maybe a new Bretton Woods system. Keep these on your radar, guys. Keep the new Bretton Woods system on your radar. Do not fall for a central bank digital currency. Opt out of that system if it comes. That's what the blockchain is for. That's what decentralization is for. We do not want to have these powers and these organizations that are biased. The people that created the Federal Reserve, nothing about it's federal, and it's not even a reserve. So it's like we need to get rid of these old systems. We need innovation. We need progress in the world. There's a lot of things to be fixed, but I hope you understand the point of this video is just kind of a little bit of a rant, a little bit of overview of what's been going on with inflation, my thoughts, some interesting articles. Again, if you have any questions, I'm happy to help. Seriously, you can send us an email. We have our email in the description of every video. We also have the Telegram channel. You can join the Telegram group and start a discussion over there if you have questions about inflation, deflation, Federal Reserve, Treasury, any of these macroeconomic topics. I'm always open to chat about it. Other people in the chat are like-minded, so that's great. Go join in the Telegram group. Also, as I talked about, go watch our must-watch videos and be sure to check this one out as well. I'll have it linked down below. That's all for today's video. If you enjoyed it, hit the like button, subscribe to the channel, hit the notification bell to stay up to date. So like, subscribe button all, invest global, and until next time.